The Fed just cut interest rates, and we're going to watch this video from Graham Stephan talking about a massive pivot ahead.
Hours ago, believe it or not, the Federal Reserve just lowered interest rates for the first time since last year.
Yes, I believe it. In fact, if you go to the CME Fed Watch tool, which is exactly what I've been showing you for weeks, and hopefully you've been watching this channel, we called exactly what was going to happen. So believe it or not, Chris was on this for months.
Marking the end of the most restrictive tightening cycle in history. Yes, you heard that correctly. The money printer is turning back on once again. And that means there's going to be some pretty serious implications across just about everything, from the stock market, the housing market, the national debt, and even the value of the US dollar. So given these shocking new updates and their brand new predictions as of today, let's talk about exactly what just happened, what the Federal Reserve just said, the impact this is about to have on everything money, and then finally, how you could use this information to come out ahead profitable. Because there's a lot going on under the surface that very few people are talking about. Although before we start, if you appreciate these breaking news videos like this, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. I know it's stupid to ask for it, but it does help tremendously, and as a thank you for doing that, I will do my best to read and reply to as many of your comments as I can. So thanks so much, and also a big thank you to the Gemini credit card for sponsoring this video, but more on that later. All right, now in terms of what's about to happen, let's talk about the topic on everybody's minds, and that would be interest rates. Even though our economy is so far overall still healthy and GDP is continuing to grow, Jerome Powell finally admitted that the downside risks are rising, and as a result, he recently said the conditions allow us to proceed carefully as we consider changes to our policy stance. This is completely different from what we saw a few months ago, prior to shockingly low job numbers when the Federal Reserve strongly resisted these rate cuts. Even now, we have inflation creeping back towards 3%, revised job numbers that continue to decline, and a weakening US dollar, leaving people wondering, why all of a sudden is the Federal Reserve cutting rates now? Well, like it or not, it all has to do with one topic that's been grossly underreported, and that would be jobs. Like I mentioned earlier, the Federal Reserve is in charge of maintaining policies that promote a healthy labor market, or I guess in other words, an economy that keeps people steadily employed. And as it turns out, a lot of people are falling behind. For instance, the Bureau of Labor Statistics just revised their job numbers down by the largest amount on record, showing a loss of 1 million jobs, more than they originally expected. They even said that this was more than 200,000 deeper than economists predicted, and it's worse than the 2008 crisis levels. This is why some experts have now begun to say that the Federal Reserve is too late to cut interest rates, and that a lot of this could have been prevented ahead of time had they eased their policies and cut rates sooner. On top of that, others believe that the Fed rate cuts now signal that 3% inflation is the new 2%, meaning they're never going to get prices to come back down to where they were before. Although in terms of lowering interest rates even further and potentially causing even more inflation, unfortunately there is one thing getting in the way, and that would be the 10-year Treasury. So here's what...
Okay. So the 10-year Treasury is absolutely 100% not the Fed funds. So keep that in mind. The 10-year Treasury is used as the basis for most loan products that are 10 years or greater in duration. For example, mortgages, right? Mortgages, it doesn't matter what kind. If you get a 520 HELOC, if you get a 15-year fixed, if you get a 30-year fixed, whatever, the 10-year note is basically the baseline for this. Why is that? Because institutions, financial institutions, actually make investments as well. They don't just make loans, they make investments. So they consider the 10-year point on the yield curve to be what a risk-free investment would be to them as an equivalent to taking a longer duration loan. Okay, so let's say that Rejo, who hit the like button, that's a brilliant idea, you should also do the same, needed to get a 30-year mortgage for his new pickle house. Okay, Rejo needed a new pickle house, so he comes to the bank and he says, I need a 30-year mortgage. And the bank is like, cool, no problem. Well, the 10 years at this, we need to make a spread for the additional risk that we're taking for you, Mr. Rejo, Mr. Pickleman. And because of that, we aren't going to give it to you for what the 10-year rate is at right now. We're going to put on what we call a spread on top of that. And that goes into the servicing costs to create the mortgage, to service the mortgage, to also build in for loan losses, right? Because they don't make one mortgage, they make dozens or hundreds of mortgages every single day. So all of those go into a mortgage pool. This is what's called a mortgage-backed security, okay? So all of those go into a mortgage pool. And in that mortgage pool, it's going to have all kinds of different things. Think about it like a portfolio of mortgages. Some of these mortgages are going to default. Some of these mortgages are going to be great and they will pay forever, all the way up until termination point, right? Their maturity point. Some of these mortgages will pay off really fast. So we need to establish what's called a weighted average life. So over the course of all of our mortgages, we establish a weighted average life of those mortgages. And in a nutshell, guess how long it is? Guess how long it is in the chat. Go ahead. Guess how long it is. Guess how long it is. If you guessed around 10 years, you're a winner. You're a huge winner. That's the weighted average life of their mortgage portfolio in total, which comes to approximately the same as the 10-year Treasury note. Who would have thought? Okay. So the mortgages are going to be costing more to the consumer because that is how the bank makes money. They could go out and they could buy all the treasuries they want at the 10-year yield, or if they have sufficient demand for mortgages, they can then sell those mortgages to consumers. Okay. But the 10-year notes, the 10-year bonds are not the Fed funds rate. So if the Fed lowers rates, you would assume that that means mortgage rates will go down too. That's not necessarily going to happen because everything that's longer than overnight, literally everything that's longer than overnight, is not determined by the Fed. It's determined by the origination of what that note is at whenever it is issued. And it's also determined by the bond market itself, by the traders who trade it. And bonds have an interesting thing where the price of the bond goes down while the rate goes up and vice versa. So they can disconnect for a long time. And in fact, I want to show you the US Treasury curve. So this is what the US Treasury curve looks like. This is the Fed funds, the overnight rate, the shortest rate possible, reverse repo rate, overnight rate. This just got dropped, okay? Now, the rest of the curve, as you can see here, can be all over the place. We've got some that are 2 and 3 years that are way less than the overnight rate. And then we've got some that are more than the overnight rate. Now, this is not a normal interest rate curve. A normal interest rate curve looks like this, where the short end of the curve is down here, the long end of the curve is up here, and then it's a pretty gradual slope from one end to the other. That's not what we have today, is it? Not at all. This is called an inverted yield curve, where the short end and the long end are both higher than everything in the middle. And here's your 10-year point right here. Here's your 10-year point. So, do I think that mortgages will be impacted? Mortgage rates will be impacted by this? Yeah. But that has no guarantee that it will be a linear change, right? From the overnight rate to the 10-year rate. It could be up, it could be down. We really do not know. But surely Graham Stephan knows. Let's listen to him.
Most people don't realize the Federal Reserve is in charge of controlling and managing what's called the federal funds rate, which is basically the interest rate that banks pay other banks anytime they lend each other money. This is important because the federal funds rate impacts what's called the short-term Treasury yield. And yes, if that sounds confusing, think of it like this because it's very important. On a very broad level, the United States borrows its money by issuing what's called treasuries, which is basically a fancy word of saying it's an IOU that promises a certain rate of return over a certain period of time. In this case, when the Federal Reserve lowers the federal funds rate, like we just saw today, these short-term treasury yields don't need to pay you out.
This is only, and I'm telling you, because I've worked in consulting specifically on interest rates for over a decade. The Fed funds rate only impacts the overnight rate. Every other point on the curve is determined by the issuance of the treasuries at the time and the traders who trade these on the open marketplace. The Fed funds has no bearing on any of these. Can it pull those along with it? It can, but it is not a direct causation.
Out as much money, and as a result, they go down. Good news, right? Because borrowing gets cheaper, mortgages go down, stocks go up, right? Not so fast. When it comes to that, those factors are all influenced by what's called the 10-year Treasury yield, as you can see right here. And this is entirely dictated by market supply and demand. That's right, if investors believe that this is a good deal, bond prices go up and the yield goes down. But if investors think that inflation isn't over, or they're pessimistic about the economy, or they just lose faith in the United States, bond prices go down and interest rates go higher, pushing every other interest rate back up alongside with it. And if you think this can't happen, it already has. As you can see, despite the Fed cutting interest rates throughout 2024, mortgage rates didn't budge. In fact,
That's exactly what I've been telling you. The Fed does not control the interest rates that you will end up paying. This is a really nice graphic right here, by the way. You can see the bottom red line, that's the Fed funds rate. And then the mortgage rates are the black line right there. And you can see that spread. You can see that spread. This is where banks make their money, is the spread. When the spread narrows, they are less enticed to make mortgages. For example, why would I want to go and make a mortgage that I might make 50 basis points on? 50 basis points is like 0.50%. Okay. Why would I want to go make 50 basis points on something that I now have to service? I now have to build in loan loss provisions. I now have to worry about, is the person actually going to pay back, right? Now I have to go find a certain percentage of mortgages that have defaulted. When all I have to do is then go invest in treasuries and not do anything, and I can make almost the exact amount of money with way less headaches. On the flip side, down here, banks are screaming, I need you to take a mortgage. Please take a mortgage. Please, please, please. And in fact, I remember specifically working with a credit union in LA, and the credit union CFO thought she was a genius at the time. And she was like, I need extra yield. So I'm going to take what I normally would put in 2 and 3 year MBSs, mortgage-backed securities. Think of that as like a CD, right? It's a CD but instead of it being, just a promissory note where they're saying, you'll get your money back and we'll pay you X% over time. It's a mortgage-backed security. So it actually has mortgages built into it saying, I now want a cut of this mortgage pool. I don't know if you know, but I definitely know what I'm talking about here. So I want a cut of this mortgage pool. It might be a $10 million mortgage pool and I'm going to buy $1 million of it, right? And that rate is going to pay higher than a risk-free rate, because the risk-free rate is basically nothing. And so this credit union CEO or CFO thought she was a genius. And so she's like, you know what? I usually go like 2, 3, 5 years, but I needed more yield. So I went with the 25 years. Now, to her, it made sense because it's an immediate 40 basis points more. But she just locked up, let's just use round numbers here, $1 million of capital that the credit union could be used to putting into mortgages, actual mortgages that they could originate, or auto loans, or credit cards, or anything else that is a revenue driver to the credit union. She just locked it up for 25 years to get like 40 basis points more than she would have for 3 years. Now, in a declining rate environment, that can make sense, right? If rates are screaming lower and you can lock it up for a longer duration, that actually makes sense to you as the person who's going to be receiving the interest. But in a rising rate environment, or an environment where rates are zero, they're not going to go anywhere down. The only where that they can go is up. Locking it in for a longer duration is so dumb. And then there was another credit union in Richardson, Texas. I won't give you any other details than that. I remember specifically, he did a very similar situation where he went super long duration on the mortgage-backed securities. And then the regulators came in and they're like, listen, you messed up. You done messed up. We aren't going to let you keep these long dated maturities, right? We understand you were trying to capture some yield here, but it's not going to happen. So they made him sell off everything. It was a $50 million portfolio. And I remember him calling me and he's like, man, I messed up big. The regulators came in and they're making me sell all of these investments. And I'm losing $1 million a day because these investments also have a market value. In order to liquidate these investments, he was having to write off $1 million loss per day to sell off this $50 million portfolio until he was able to get it off the books. Now, granted, this is way beyond the scope of what you're ever going to have to worry about as an individual investor, but I want to give you some perspective on what's going on here. When rates are ultra high like this, they're not motivated to take all the mortgages because that spread is not very high. When rates are super low, hell yeah, they're motivated. They're going to make sure that they make as many loans as they can because they need that spread. Otherwise, they can't pay the bills.
Briefly went even higher because investors feared a return of inflation. The same thing also occurred throughout the 2001 dot-com crash, and also through the early 1990s rate cuts. In each of those, mortgage rates weren't really affected, and even though they trended downwards, that was more of a reflection of lower inflation expectations and an improving economy than what the Federal Reserve did. That is why some people believe that sure, even though the Federal Reserve lowering interest rates could be a sign that more free money is going to be flooding into the economy and sparking a new wave of spending, practically, if inflation remains high or the economy suffers, the interest rates that matter the most could remain unchanged or even go higher if the United States starts looking less appealing. And this is where a lot of the trouble begins. Like on May 16th of this year, Moody's downgraded the US in terms of their future outlook, going from what's called a AAA rating to AA1, meaning that investing in the United States is no longer as enticing as it used to be in the past. On top of that, Moody's has pointed out that Congress has continuously failed to reduce the national debt and excessive borrowing. Over the next decade, they expect larger deficits as entitlement spending rises while government revenue remains broadly flat, and future performance is likely to deteriorate relative to past performance. That's why they project that by 2035, interest payments will make up 30% of the total budget, which is insane. Now, even though the United States has never defaulted on its debt and realistically probably never will, this does suggest that the US will have no other choice other than to continue printing more and more and more money. And if fewer investors are there to buy that debt, the 10-year Treasury could continue to remain high. And that is where a lot of the problems begin. Although before we go into that, here's the reality. The more money the government
I will not listen to an ad, but I feel like this is an ad.
prints, the less each individual dollar is worth over time. That's why I personally think it's so important to diversify and
No, we will not listen to ads. Skip ads. Hang on. Here we go. By the way, Mr. Keene has a brilliant I was going to say brilliant quadragy. Yes, of course. Professional YouTuber doesn't know how to say question or strategy without mixing the two together. Quadragy. A brilliant quadragy from Mr. Keene. Do we really need this info since we follow the outlier strategy? Absolutely not. Absolutely not. But a ton of people really care about what the Fed is doing. A ton of people really care about what the Cowboys are doing. A ton of people really care about what the Yankees are doing. Not this guy. I give no monkey donkeys about stuff like that, but a ton of people do. A quackagy. Yes. Scrooge McDuck is in my blood.
And now let's get back to having the entire economy. Let's talk about the housing market. In terms of what we're currently seeing, it's no surprise that housing prices are beginning to slump as more inventory gets listed on the market. And for the first time in years, housing is beginning to lag inflation. In fact, it's said that American housing wealth has actually declined in inflation-adjusted terms over the past year. What's even more apparent is that we're quickly noticing a very big divide in the housing market between those who locked in historically low mortgages and those who bought in the last 2 years. Like, as you can see, the average existing interest rate on California mortgages is currently at 3.8% versus new.
Go back. Okay, so this is a huge point for the real estate market, right? If the average rate on all mortgages in California, I don't know why he pulled California, is what it is, but in this particular data point, if the average rate is 3.8% and the current rate on new mortgages is over 6%, how motivated are you to be like, you know what? I think I'm going to go out and get a new mortgage. I'm going to refinance. You're never going to refinance. The refinance rate is 0. Not going to happen. How about I go out and buy a new house? Oh, geez, with the mortgage being up as it is, nearly 50% higher, that means my mortgage interest that I'm going to have to spend every month is going to be 50% higher. And the price of the houses have gone up probably 50% in the last few years. My mortgage payment's going to basically double or triple. Geez, I don't know about that. So that plays a huge part, right? Who out there is going to go refinance from 3.8 to 6.5? Nobody. 0. The refinance rate is 0. Who out there is going to say apples to apples, house to house? Am I going to move from one house to another, get a new mortgage, and have to pay 50% higher on my mortgage? No, 0. Not going to happen. So this is really hard on the real estate market in general. And I know, I forget what his name is. I think it's Brian, one of our real estate brokers, I believe. Forgive me, I can't remember your name off the top of my head, but from Houston, one of our real estate brokers, he can definitely jump in and let us know. Matt, there it is, Matt. If they did decide to sell, they'll be paying more for less. Matt, thank you. I was thinking of exactly you. Thank you so much. Yeah, exactly. This is hard on the real estate market. A 25 basis point cut isn't going to cut anything. I mean, we're talking almost 3 entire percentage points, almost 300 basis points higher. Nobody's moving, period. And I'm sure that actually has a huge impact on you, Matt. But listen, Matt, when I need to buy a house next year, I'm going to reach out to you because I need people that I can trust. And I trust you, my friend.
The average existing interest rate on California mortgages is currently at 3.8% versus new mortgages coming in at 6.6%. This means you have one segment of the market locked into low interest rates and refusing to move, while the other is paying double for an identical house. Given that, when a home is listed, buyers now have more room to negotiate. They can afford to be pickier because there is more to choose from. And when you look at the overall buyer pool today, there are fewer people willing to pay today's prices that haven't already purchased something. Of course, in terms of whether or not lower interest rates are going to positively affect the housing market, the answer is it depends. Unfortunately, like I mentioned earlier, the Federal Reserve does not have a direct impact on mortgage rates. Instead, those are influenced by the 10-year Treasury yield, which are dictated by market supply and demand. That's why there's a good chance that mortgages will remain relatively unchanged for the near future, unless the Federal Reserve starts buying the 10-year Treasury yield in an effort to pump more money into the market and drive those yields down, which at this point...
So, listen to what you just said right there. Has nothing to do with the Fed funds. I'll back up just a moment.
Will remain relatively unchanged for the near future unless the Federal Reserve starts buying the 10-year Treasury yield in an effort to pump more money into the market and...
Unless the Fed starts buying treasuries, which is the money printer, right? They're buying treasuries with no money. It's like literally writing a blank check, taking it to the bank, and the bank being like, you don't have any money in your account. You're like, that's fine. And they're like, oh, you're right. You're right. Here you go. Here's your money. That's precisely exactly what it is.
Drive those yields down, which at this point, nothing would surprise me anymore. Plus, if they actually did...
Okay, Julian, I did not work with Silicon Valley Bank in 2023, but I can tell you exactly what happened to Silicon Valley Bank in 2023. Because in the midst of all this, I had to basically talk all kinds of credit unions off of jumping off of bridges. What happened was they went super long in duration, kind of like we talked about earlier. And the feds came in, kind of like we talked about earlier, and they said, you must liquidate these now. So they started liquidating them. Okay. They took, I believe it was either a $400 or $600 million loss on these investments that they made. This was a multi-billion-dollar institution. But if you're telling me that the institution now has 60 cents on the dollar that the depositors put in, we got problems. Word started leaking out. Silicon Valley Bank doesn't have your money anymore. And then a bank run happened. Therefore, Silicon Valley Bank had to then liquidate even more of their investments in order to pay the people who were saying, I need my money right now. Therefore, tanking the value of those investments. And it was a cascading house of domino cards that it all fell all at once. Exactly what happened. Why would the regulator do that? Because they don't want the institutions to have that much risk on the balance sheet, right? Because if rates are at zero and you have a 30-year portfolio, and if rates go up, you're going to be underwater on all those investments that you will, at some point in time in the future, have to sell them at a loss. The regulators are coming in, they're saying, you know what? You got to get rid of these now before things get worse. The issue here that puts them on the highway to bankruptcy, which is exactly what happened. The issue that happens is that they can't pay back their depositors now or in the future. And if they can't pay back their depositors, they're insolvent. And then it's gone. It's gone just like that.
Do that. It's probably a sign that investors have lost faith in the U.S. economy, and it's a bad sign. Anyway, barring the Federal Reserve purposely...
Jamie, I appreciate you thinking about that, my friend.
stepping in to bail out the housing market, realistically, housing prices will continue to soften as more inventory gets listed on the market.
Sylvia nailed it exactly. This is too risky. You need to sell these, and you'll be even worse off if you don't do it now.
And prices might begin to decline relative to inflation. On top of that, national home prices have remained fairly stable, so it's unlikely we're going to see a crash, but a softening is definitely something that's in the cards. Although a bigger problem right now might actually be the stock market. Unfortunately, we have a few variables all affecting stock market performance, with the first being treasuries. Like I mentioned earlier, for the foreseeable future, the long-term treasury yield is going to act as the barometer for our entire economy, because this is seen as the risk-free rate of return that every other investment is compared to. Like, to put this into context, if the 30-year treasury offered a risk-free guaranteed 10% rate of return, why would you invest in the stock market where you might get an average of 8%? Or why invest in real estate for a 7% return?
Okay, I totally see why y'all are talking about his hands now. Should I do more hand movements? Should I do more of that? Listen, when we talk about the stock market and we talk about interest rates, the Fed funds will not make a difference to what the interest rates are going to do to drive the market up or the market down. Okay, so let's go look at the markets. Okay, so what we're looking at here is the S&P 500. Okay, this is Mamma Mia. This is the S&P 500. Yes, exactly. Looking at the S&P 500, as you can see, has been going up for gangbusters 4 years as the Fed raised rates. Now, traditionally, the rule of thumb is if the Fed raises rates, that's bad for the stock market. Because why would people invest in the stock market if rates are high? They can go invest in something else. This line right here is the Fed funds rate. It went up. It stayed up. What did the market do? It went up. And then people were saying, well, if rates go down, that's going to crash the market. Please don't try and tell me that people weren't saying that, because I know they were. What happened? Rates went down, market go up. It's just really funny when people claim that the Fed funds going up is going to tank the stock market. Please show me where the market got tanked as the rates were rising. Right? That's sure, I'll give you that. That was the COVID pullback right here. Absolutely. Oh no, this was the COVID over here. Had everything to do with the rates going up. Yes. No. Then they crash rates to make sure that people can go out and buy whatever, and rates skyrocket higher. I'm sorry, the market skyrockets higher. And then they raise rates because of inflation, and therefore it must crash the stock market. And what happens? The market goes up even higher. Man, isn't that crazy? It's almost like the Fed will not determine what the stock market's doing. Rates go down, market go up. Rates go up, market go up. You can't explain that. Wow, it's like price doesn't follow fundamentals. Exactly. So why do people get so worked up about the Fed raising rates or lowering rates when they try and make that correlation to the market? Because as you can see, has no impact. They are decoupled. At one point in time, that may have been the thing, but let's go back to 2006. They are decoupled. Fed rates go up, SPY goes up. That shouldn't happen. Rates go down, market go down. That shouldn't happen. Rates go up, market goes up. Rates go up, market goes up. Rates go down, market goes up. It's just not a thing anymore. It may have been at one time, but it isn't today.
When you could invest in this with no risk or work whatsoever. That's why the more these long-term yields offer, the cheaper other investments need to become in order to compete. And this is what brings us to the first issue. Treasury yields have been rising. In this case, investors are worried that deficit spending is growing out of control. Core inflation is back near 3%. And if the US dollar loses some of its appeal, the market could fall because Treasury yields will rise. The second, we have concentration risk. As you can see, the top 10 companies now make up 40% of the entire S&P 500. And even
this is something I'm worried about. Concentration risk. The That is real. So the S&P is a market cap weighted index, and I like to show this every once in a while. This is the stock market heat map from FinViz. The largest 10 stocks make up 40% of the market cap wise. That gives me concern. It should give you concern. Because let's say Microsoft, Nvidia, and Apple, let's say that people start falling in love with tech stocks and their prices go down. That can't happen, Chris. That's never happened in the last ever, and so therefore it will never happen ever again. But what if it does? Let's just say it does. Because they are the big boys. They're swinging their big bananas around all over the place. They are going to pull the market whichever way they go. And if they go down, the market goes down with them. And so that gives me a lot of concern.
The top 10 companies now make up 40% of the entire S&P 500. And even crazier is that Nvidia now has the biggest weight in the S&P 500 of any individual stock since the data began in 1981. This is bringing us to a very close comparison to the early 2000s dot-com bubble, where at the time, the top 10 companies made up just 25% of the index, which, hey, back then that was a big deal. However, even though market crashes have historically followed periods of high market concentration, like we're seeing now, the data actually shows that market concentration alone doesn't predict future stock market performance. Why? Well, sometimes market concentration is earned by fundamentally strong companies who make a ton of money, while other times it's fueled by speculative mania about to burst. That's why a more reliable indicator of a market bubble is simply how fast the market concentrates. And the faster this occurs, kind of like what we're seeing with Nvidia, the more vulnerability there is for a drop. Of course, that's not to say that we're due for a crash or that the market will just keep going up indefinitely, but it is a reminder of why it's so important never to put all of your eggs in one basket, and preferably to diversify across as many different asset classes as possible. Although in terms of what Jerome Powell just said...
So I kind of disagree. Thanks to one of my mentors, Mark Minervini, one of the greatest traders of all time. And then I forget there's another wizard who has this quote, but he said, yeah, I think it was the guy who worked with George Soros, Stanley Druckenmiller. Stanley Druckenmiller had this quote. He said, put all of your eggs in one basket and watch that basket like a hawk. In my opinion, if you want outsized super performance, that's what you're going to have to do. You're going to have concentration, kind of like the market, right? If the market wasn't concentrated in those stocks and those stocks weren't performing, do you think the market would look like it does? Absolutely not. It's because of that concentration that drives the outperformance. So, do you need to diversify? I mean, if you want average returns, do the same thing that average people do. But if you want outsized super performance returns that are going to win you the US Investing Championship in 2026, like I will, you can't do that. You need the concentration, and you need to be concentrated in stocks or assets or whatever that are crashing up. Don't you dare. Don't even think about it. Buying assets that are crashing down. That is the most dangerous word in the shit. Most dangerous word. I can't even. My point was thrown out the window because I tripped over my own tongue. The most dangerous word is should.
And what this means for you, here's what you came for. As of a few hours ago, the Federal Reserve cut interest rates by 25 basis points, mainly due to one segment of the market that's really beginning to suffer, and that would be jobs. As you could see, for the first time in 4 years, the United States officially has more unemployed people than there are job openings. And this means lower interest rates are coming to the rescue. After all, if businesses have cheaper access to capital, the more likely they are to reinvest, the more money people should have left over to spend on everything else, and the more this should help prop up the entire economy. Now, in terms of where these jobs are going, it appears as though AI does have some effect. Like even the Federal Reserve said that industries which use AI are seeing a higher unemployment rate than those which don't. So that's something to consider, especially now when one person is able to do a lot more work than they were previously. Although in terms of what else Jerome Powell just said, overall, he was a lot more cautious about the economy than in previous meetings. He still mentioned a concern of whether or not tariffs would have an impact on inflation. and that's why they're taking it meeting by meeting to determine what's going to happen next. However, in terms of where they expect the market to move over the next few years, today is where they release what's called their Summary of Economic Projections, which details exactly what they anticipate to happen in the near future. And now the Federal Reserve has made it clear that they expect to cut by another 50 basis points by the end of the year due to growing job uncertainty. On top of that, they're predicting that inflation will remain above 2% throughout 2028, suggesting that their plan is overall to cut aggressively in 2025 and then take it a bit slower throughout the next year, depending on the data. Beyond that, Jerome Powell went on to say that today was a risk management cut and that job growth was below break even. So the market currently believes that the Fed might be too late to cut interest rates, which is why everything has begun selling off towards the end of the day. So overall, in terms of what I think, look, the jobs numbers were
selling off towards the end of the day, and yet here we are, like 6 hours later, and pushing brand new all-time highs. Right? Stay in your lane, Graham.
pretty bad, and it's not surprising the Federal Reserve is stepping in to rescue the market, even though they're doing that at a time when asset prices are near an all-time high and inflation remains elevated. This is going to be a really unique spot for them to be in, because on the one hand, if they lower interest rates too much, they risk inflation coming back, but if they wait too long, they risk the unemployment rate rising. It's going to be a really delicate balancing act, not to hurt one for the sake of the other. That's why I wouldn't be surprised if we see another small rate cut when they meet in October, and maybe...
Well, I want to quantify that because I don't know if Graham knows about this, but I sure as hell do, and so do you, the CME Fed Watch tool. So if we go to October, so the current rate, they've already updated this to be at 4 to 4.25 versus yesterday it said 4.25, 450. There is a 12% chance as of today. Now, of course, this will update on a daily basis. There's a 12% chance of no rate cut by October and an 87.7% chance of another 25 basis points by October. Now let's go to December. There is a 1.8% chance that they will keep the rates unchanged, a 23 basis point chance that we'll be down just a quarter point, and a 75% chance that we'll be down 50 entire basis points. Now let's look out an entire year from now. Let's go to next December. Of course, a lot more uncertainty. But there is one certainty, and that is at none of these intervals does it show the current rate. Some of these intervals show at least a 100 basis point cut by the end of next year. In fact, if we do the math here, 15, 20, an 80% chance that we'll be down an entire 1 percentage point by the end of next year. Now, this is not some fancy exclusive tool that you need to spend tens of thousands of dollars on. You go to Google, you type in CME Fed Watch Tool, you get this. And I just showed you how to read it. So you are now way more knowledgeable about what the likelihood of the interest rates will be than Graham Stephan right here. And he probably has this face when he finds out. Either way, don't base your portfolio, don't base your trading, don't base anything that involves risk on what you think the Fed is going to do. If the rates go up, that is no guarantee that the market will go down. If the rates go down, that is no guarantee that the rates will go up. They have decoupled. That correlation may have existed, but it is gone now. Trade what you see in front of you, keep your risk in check, and make sure that you save time, make money, and start winning with less risk by clicking one of these two videos. Talk soon.